Hello and welcome back. We're now going to take a closer look at Nagarro SE, which will be presented by Michael Knapp, who's Head of Investor Relations at Nagarro. We cover this company and you can access the research on Research Hub or with a link that I will provide to you shortly in our chat box on the lower right-hand corner. Also, if you have any questions during or in the aftermath of the presentation, we will have a Q&A following and we will address the questions that you put into our chat box accordingly. We will record this presentation and you will be able to access it a little later on Research Hub. And with all this in mind, Michael, I look forward to what you have to share with us.
Great. Well, thanks so much, Holger, and good afternoon to everyone. And thank you for joining the NWB Research Conference. As Holger mentioned, I'm Michael Knapp. I'm the Head of Investor Relations at Nagarro, and I'm pleased to have the opportunity to share a company update with you today. Before we begin, please note that this presentation does contain forward-looking statements. They are subject to change, and you can refer to our investor relations materials for full details there. For those that don't know the company, Nagarro is a global digital engineering leader, and we're focused on helping our clients innovate to win in their respective markets. We're operating with over 17,000 employees across 39 countries, and our core approach is built on entrepreneurship, agility, and what we're calling fluidic intelligence. And I'll talk a little bit about what that means a little later in the presentation today. We like to think of ourselves as the perfect size digital engineering partner for our clients. We're more nimble, agile, and client-centric than some of our larger IT services providers, but we're also more robust in terms of engineering expertise and a better global delivery model than some of our smaller peers. We went public in 2020, and looking at our historical performance here, I think the trend is clear. We've consistently delivered strong growth in both strong and weak demand environments. In 2024, our full year revenues reached 972 million euro, which was up from 430 million euro in 2020, which represents a greater than 20% compounded annual growth rate. Gross profit and adjusted EBITDA also showed similar impressive growth across the period, with adjusted EBITDA reaching 147.5 million in 2024. I think this performance demonstrates the strength of our business model as a digital engineering leader. And on the next slide, we can look at some more recent performance. In Q3 of 2025, we continued our strong execution, achieving 255 million euro in revenue. Some of the key performance indicators for the quarter here include year-over-year revenue growth of 9.4% on a constant currency basis, pretty strong 33.1% gross margin, which was ahead of our expectations, an adjusted EBITDA margin of 17.3%. That was also above our expectations and also the highest level we had seen since 2022. Cash balance remains healthy at 129 million euro, and we now have 187 accounts generating over 1 million euro in revenue. And we think this is an important metric since once we reach that 1 million mark with clients, they rarely turn over, and it allows us to continue to grow with them across their business units. We also have an NPS score of 69, which we view as quite strong. For full year 2025, our current guidance reflects the lower end of our original guidance range, which, just for reference, was 1.02 to 1.08 billion provided in January of this year. Note that we've seen some significant headwinds to revenue related to foreign exchange rates, especially the conversion between dollars and euros. If we were to adjust for these foreign exchange impacts, we'd be near the midpoint of our initial 2025 full year guidance that we had issued at the beginning of the year. Also on our Q3 call, we maintained our adjusted EBITDA margin guidance, projecting a range of 13.5 to 14.5% for the year. Note that this also includes a significant impact from FX volatility, which I'll talk a little more about on the next slide. We recognize that our reported adjusted EBITDA figures for Q1 and Q2 have been significantly impacted by fluctuations in FX rates. specifically related to non-cash impacts on loans between different companies within the Nagarro Group. Here, I just wanted to highlight that our adjusted EBITDA margins might have looked what they might have looked like for the past 3 quarters if we had corrected for the FX impact on intercompany loans. The resulting adjusted margins would have been materially higher and more representative of our resilient operational model, with over 15% adjusted EBITDA in the first half, moving to over 17% in the last quarter. We've been highly focused on improving our corporate governance and enhancing capital allocation discipline over the past year or so. Significant items include appointing a new auditor, enhancing our reporting and disclosures. We expanded our board by 3 individuals, stronger risk management and internal controls. We're also getting close to naming a new CFO as well, so please stay tuned for that announcement to come soon. If we look at our capital allocation discipline, we've focused on a balanced approach, which includes share buybacks, dividends, as well as M&A, and we can talk more about that in detail shortly. Our diversified revenue base provides both growth and stability for us, and you can see this balance across the industry we serve, and this is from last quarter. We're starting to focus our sales efforts more in areas where we feel we have the right to win, and also in larger and faster growing vertical markets. We've also outlined in some past calls some of our biggest secular opportunities in Japan, the German Mittelstand, and IoT hardware, and now in supply chain as well. And we're developing playbooks on improving our discipline around some of these areas. We see this improved execution of discipline and improved focus on commercial excellence as a new phase in our journey. In terms of customer concentration, the rest of our clients beyond the top 10 account for 76% of revenue, kind of reflects a healthy lack of concentration amongst our clients. We are committed to maintaining a healthy net leverage ratio, which is calculated by net liabilities divided by the last 12 months of adjusted EBITDA. As of September 30th of this year, our net leverage ratio stood at 1.7 times. Regarding cash flow for the first 9 months of the year, we've generated over 77 million in cash from operations, or a little over 33 million euro in total cash flows. For our capital allocation strategy, it's focused on maximizing stakeholder value through efficient capital deployment. And I mentioned that we have a balanced approach here. For share buybacks, we've bought back approximately 684,000 shares for 50 million euro, and that's through June 30th of 2025. We also just announced on our last call the continuation of the buyback program of up to 20 million euro. In addition, we also plan to cancel 75% of our treasury shares to free up some capacity for future buybacks. For dividends, our sustainable annual dividend policy targets distributing 10% to 20% of EBIT. The dividend declared in June of 2025 was 12.6 million euro, or about 13% of our 2024 EBIT. For inorganic growth, we continue to pursue smaller tuck-in M&A opportunities. So at the heart of our client value proposition is an approach we call fluidic intelligence. And when we say fluidic intelligence at Nagarro, we're describing a fundamental shift in how individuals, technology, and enterprises will operate in the age of AI. It's kind of a rethinking of how human judgment and machine capability are going to come together to create big productivity gains. At the individual level, it's redefining work by elevating humans to strategic decision makers who seamlessly orchestrate with AI agents to execute some complex tasks with unprecedented speed. Technologically, it unlocks trapped institutional knowledge and data silos instantly bringing the right contextual insights to solve problems without the delay of trying to piece together fragmented information. And organizationally, it unifies the entire enterprise into a friction-free ecosystem where cross-departmental workflows are intelligently automated, and they allow for large companies to move with the agility of a startup. So this direct result of this approach for our clients is a 20% plus uplift in productivity and of speed. And a good example of this is the work that we've done with Dublin Airport, which is the 12th largest airport in Europe. It handles over 30 million passengers annually. And the challenge they face, which is common to many large organizations, was over 1,000 critical operations systems scattered across disconnected silos, led to fragmented data, operational chaos, and really reactive decision-making. And with our AI accelerators and systems thinking approach, we're unifying these diverse systems into a single source of truth. And it ultimately revealed 4 key use cases: achieving a single live view, enabling passenger forecasting, unlocking global retail insights, and also building airfield resilience. So the resulting business impact was immediate and significant, resulted in fewer delays, lower overhead. It increased augmented revenue and created for frictionless passenger flow. And we're planning to replicate this success across the industries we're serving. We're really privileged to work with some of the world's most recognized and forward-thinking companies in the industry today. Loyal clients who've worked with us year after year, and they include companies like 3 of the top luxury car manufacturers, 3 of the top 5 global leaders in industrial automation, 5 of the leading global retailers, 2 of the 3 top hotel groups in the world, and the list goes on and on. So we're proud to be inventing the future alongside these industry-leading clients across all of these major sectors. And in summary, Nagarro continues to focus on strong financial execution, disciplined capital allocation, and really delivering a powerful digital engineering solution through this fluidic, intelligent approach. And with that, I'm now happy to take any questions you might have.
Thank you so much, Michael. We do have a few questions already, and I will just take them from the top. One of them is quite interestingly and quite broad. What's the current tone of IT investment and budgets that you see also going into 2026? Is there an improvement, or do you expect it to be stable, or what do you hear on the ground or your salespeople?
Yeah, it's a good question. And maybe if I take it from a few years back to where we are now, we came out of 2020 and there was a big approach post-COVID to invest heavily in IT. And so what you saw in 21 and 22 was really potentially over-investment in IT as people scrambled to get systems in place to deal with the new world environment. I think since 2022, we saw kind of a digestion period in 23 and 24, and even part of 25. I think what we're really excited to see is things are picking up, and we're starting to see investment coming back in all types of projects, but particularly in AI-centric projects. And I think while there was some pause also, in addition to the digestion, there was this pause of companies trying to figure out how are they going to best use AI to get these productivity gains. And so there was a lot of exploration, but didn't result in a lot of actual projects and revenue. And we feel like we're through that now. So we are seeing investment coming back, and frankly, it's investing in technology is essential to stay competitive in any market. And so we're really encouraged with what we've seen in the past couple quarters, and I think that's going to continue in 2026. So we're a lot more optimistic than we were over the past couple years. We really feel like we've kind of made it through that pause in IT spending. And again, it's not a celebration off to the races, but it certainly seems like it's bottomed and improving.
In the same context, looking into 2026, and I'm sure that you are not very open to talking about this, but the question that one person asks what your key priorities and targets for 2026 are, and if you already can provide some color on this.
Yeah, we haven't explicitly provided guidance. We typically do that at the beginning of the year. I think if you look back historically, we've had varying growth rates on the top line. And I think, for 2025, particularly with some of the FX impacts, we're still kind of in this mid-single digit growth phase. I mean, longer term, our goal is to grow double digits, and whether that's in 2026, we'll have to see. We'll provide more explicit guidance there, but certainly getting back to double digit top line growth is a priority for us, and we think we have a path there. I think on the bottom line, when you look at adjusted EBITDA, here we were doing about 17% last quarter, which is a pretty solid operating margin. I think getting longer term, not in 2026 per se, but longer term, getting that to more like 18% is certainly a possibility for us. But we'll provide some explicit guidance, I think, by early next year on full year 2026.
Before we start talking about Fluidic Enterprise that you provide, how does that compare to what IBM offers in Sonics?
Yeah, so a lot of different players in the IT services space kind of have different approaches. Again, we kind of, I think I mentioned this at the beginning of the presentation, but we kind of see ourselves as a really ideal sized partner for our clients. A lot of times you have bigger folks like an IBM or like an Accenture, and what we've found and heard from customers is sometimes the vast scale of these organizations make it less personalized, maybe less agile, less active. We like to see ourselves as maybe a scrappier, agile, kind of entrepreneurial player in the space that really prioritizes the client experience. It's part of the reason the NPS score is part of our KPIs, is that we really value our clients and the experience that they have working with us. And typically, if we look at our client base, most of our growth is driven from existing clients. And typically what we do is we have maybe smaller projects initially that expand into greater projects once customers have the pleasure of working with us and seeing what we can do for them. I think relative to maybe smaller players, we're a lot more robust in our capabilities, and we can bring to bear all of our expertise with our leading engineers who are positioned around the world to really do anything our clients need. Doesn't really matter what technology, what platforms they're working on. We have professionals to enable that. So I wouldn't say it's necessarily different. I don't know exactly where or if we cross paths with an IBM, but I think we typically see ourselves as that in that middle kind of mid-sized realm where we're both very focused on client centricity and giving our clients the best experience they can have, and then also having greater capabilities than maybe some of the smaller players. And that's been a real sweet spot for us that we continue to try to take advantage of in the market.
Thank you. Looking at the space in some more depth, on the one hand, of course, it is a very innovative edge that you're working on, and adaptation is usually with revolutions not quite as quickly. Are there any industries where you can say that the adaptation of this new technology is much quicker, whereas others are just lagging behind? Are there any industries where you can say, okay, there is going to be growth in the short run already, whereas others might have a longer time frame adapting this?
Yeah, it's a really good question, and I think it's interesting. It's really less about industry and more about the specific client, because I think in certain industries, some clients are much further along their digital journeys than others. And so it's not necessarily industry specific, it's more client specific. And some have really good understanding of where they're going, and they just need some additional help to get there. Some are really starting at the very beginning. And I think one of the first things that we say is we're really early into this AI journey. And one of the things that needs to be done first is just to have clean enough data in the enterprise so that you can apply AI to get valid insights out of that data. And frankly, there are so many clients out there who don't even have their data ready to take advantage of AI. So that's kind of step one, is getting that in place. But I would say, if we look across our client base, we have some really exceptionally well-versed clients who understand exactly where they want to go. And on the other end of the spectrum, we have people who are really just starting out on their missions. And I don't know that it's necessarily industry specific. It's really more a function of the clients. I think the good news is everyone's investing in IT, and they understand that with AI, if they are not investing, they will be left behind. And so that the IT spending is a must, and we're happy to see that that's starting to come back in a more meaningful way.
It's a very interesting point and a very good transition to another question that was asked concerning your Mittelstand offensive that you are having. Looking at the German Mittelstand and hearing the news that's coming out of this sector, a lot of companies are complaining about the lack in profitability, high energy prices, and it seems like CapEx plans in general are not necessarily on their agenda because they're fighting for survival in some cases. Is IT for some of them something that they rather push down for a year or two because they're very strategic in nature, or are some of them at the point where they see this as a transformation to actually become profitable and make it? What's your impression?
Yeah, I think that's the best part about the IT services spend, is how you deal with a tough environment and when margins are compressed. These productivity gains that you can derive from some of the technology we're implementing is what can help. And so I think a lot of companies who may have wanted to push off those ideas and just focus on the business are realizing that this is a necessity when times are more difficult. And so what we're actually seeing customers moving forward just for that reason, that they need to get these productivity gains in order to continue to be competitive in their markets. So I would say it's more of the latter, that there may have been a period of more kind of pushback or pausing IT spending for fear of not getting the returns. I think once you can see the returns that are possible, it makes it a lot easier to justify that IT spend. And it's all about return on your investment internally. So obviously they're looking at that very closely, but I would say it's moved the other way to where they see it as a necessity to stay competitive.
Great. I have two more questions. One of them regarding the competitive environment and what you see on the one hand within your space of competitors, but also looking at larger competitors. Do you feel that the larger ones are putting some pressure on pricing when it comes to projects, or do you see pricing as rather stable?
I'd say for the most part, pricing is pretty stable. I'd say the exception is in multi-year kind of fixed cost contracts. There might be a little more pressure there. If you look at Nagarro specifically, more than 3/4 of our revenue is coming from time and materials. And there's really not been any price erosion or anything there. So I think the majority of our business is kind of protected on that front. For multi-year contracts, I think there is this idea of what type of benefits are you going to drive over a multi-year period. And so I think pricing on some of those longer term contracts have been maybe seeing a little more price pressure there, but nothing dramatic. And I think the net of it is we see the pricing environment is pretty stable here at Nagarro.
Thank you. Last question is, and you mentioned that during your presentation, there was a change in auditor, if I recall correctly. Can you just give us some more background as to why this happened? Because sometimes it makes investors really nervous if there's an auditor change. What was the reason for it, and what do you hope to accomplish by doing so?
Yeah, sure. Yeah, we named KPMG as our auditor. And I think this comes as just a function of the maturity of the company coming out of the spin. We spun in 2020 from Allgeier, and I think it was more of using what had been used with our parent company when we spun, because there's obviously a lot going on. We wanted it to not be a disruptive event, and so we continued with the same auditor that they had. I think over time there were requests from our customers that they really liked the idea of having this kind of tier one, well-known auditor. And so that was always a priority of ours. And so we did that. And I think we kind of are through that transition, but I think it was primarily a function from our investor base and stakeholders within the company saying, we really want to have, we prioritize corporate governance, and we want to have a well-known kind of global entity that is kind of known as best-in-class auditing.
Great. I don't see any additional questions, which is great because we're pretty much at the end of our 30-minute slot anyway. We will continue with the last company presenting today, which is Tony's. And in case some of you are still looking for a Christmas presents for their kids, there always is the Tony's box, and I will put the link to that presentation in the chat right now. So feel free to click it and come to the next meeting. Michael, thanks so much for the interesting insights, and of course, everybody for the interesting questions that you asked. A very dynamic Q&A, very much appreciated. And Michael, since you are 8 hours ahead, I wish you a great day. Enjoy your breakfast, and we'll all be in touch. In case you have any questions on Nagarro, please feel free to contact either us, and you find us on Research Hub, or you can, of course, also contact Michael.
Great. Thanks so much, Holger. Thanks, everyone.
Enjoy.